The Fed chair has encouraged homebuyers to wait for a reset. The reset has caused a 20% decline in sales and thousands of mortgage executives their jobs. At least, the reset is closing supply gaps and lowering prices in Austin and Reno despite the high lending rates. For today's video, we will look at the housing market price on the rise during recession. Here is what to do. Let us begin. Earlier this year, the Federal Reserve started tightening interest rates. Immediately, the 10-year Treasury and mortgage rates responded. The Fed is using the age-old trick of raising mortgage rates to fizzle out demand, which started during the pandemic. Lockdown reinvented the concept of work and government support. People receive stimulus checks, and unemployment checks are heavier on the Democrats. Thus, the U.S. housing market saw an insatiable demand that caused a housing boom. Suddenly, that boom is affecting other supply areas and projecting the fear of a recession soon. Thus, the Fed decided to discourage lending by raising interest rate points. Home sales are down by 20% from last year, and the GDP would feel the impact of a staggering housing market. Sometimes the Fed-induced recession starts like this. We will present more on that shortly. I'd say if you are a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together and where inflation is down low again and mortgage rates are low again. Federal Reserve Chair Jerome Powell told reporters when he met with them in June. He has also been hauled to Congress to testify on the current inflation and his team's approach to lower prices and encourage people to go back to full-time employment. Historically, the Fed induces recessions by spiking mortgage rates. That move means fewer home sales and more inventory. However, a housing recession is accompanied by layoffs. Currently, hundreds are losing their jobs in mortgage firms due to the current lack of demand. Conveniently, the Fed's plan seems to be working. The housing market is cooling off after 2 years of sentimental hot sales. The new sales levels are low and more homebuilders are halting construction due to the inflated prices of materials. Nevertheless, there is enough inventory in the system. Selma Hepp, deputy economist, CoreLogic, was speaking to MarketWatch when she shared that there are several indicators that the U.S. housing market is in a recession. For instance, the housing starts in existing home sales are down by 20% in comparison to August 2021. She also mentioned that houses in areas like Austin and Reno are lowering their prices due to weak demand. If housing were in a recession, the rest of the economy would follow soon, as almost everyone had predicted. We have predictions of how long the recession will last. Subscribe to this channel and find out. Further, the National Association of Realtors shared at the end of July that existing houses are listed for over 14 days before they are taken off the market. This is a new low since 2011. Despite this situation, there are buyers still waiting to step in and quickly get their share with their savings. Most of the older millennials are at the stage where buying housing is an urgency. Therefore, those people see this as an opportunity or as the market normalizing rather than weakening. One must consider the financial stress that recessions carry if they are finding the opportunity in this current housing market. Goldman Sachs and other banks are predicting recession for the next 2 years. Can you survive if you invest your funds in a house now? Think about it, and we will help you make the decision with other pieces of information shortly. As such, the focus is on whether or not it is a good time to buy. Economists are hang on that for a second. This is because they cannot confidently call it a recession. Some say a housing recession is not a real phenomenon. Unlike the 2008 financial crisis, this rising inflation is coupled with high employment. Thus, the Fed's response could be different to other times. Ken Rosen said, "Normally, if we get into a recession, the Fed would pour money into the market. This time, the Fed is not going to do that because inflation is high. This is going to be a slower response and inflation is going to take time to come down." He is the Berkeley Haas Fisher Center for Real Estate and Urban Economics Chair. Housing market price increase. What to do? First, consider your budget, income stability, and emergency funds as you decide to purchase a house. Think of the possibility of a recession and what investing in a house could mean to your finances before you join the market. In addition, your plans for the house should be a major factor. If you are permanently going to leave there, then it might be ideal to buy during the dip. However, if you intend to sell in less than 5 years, you might be losing money with the way the market is slowing down. Goldman Sachs has predicted that we could be in a recession until 2024. Nonetheless, do not let your fears price you out of the market. If you are ready, buy now. Antonio Bruno, a Friedman Group agent, said, "The best time to buy a house is always yesterday." Sellers are more realistic with pricing their homes, which buyers can use to their advantage and buy as inventory increases. Notwithstanding, he'd also shared some housing market price predictions. The other strategy is to leave cheaply and save up. Home prices are going to cool down. If you can leave with a relative and avoid paying rent, you can save like crazy. He believes that mortgage rates will drop by 4% if we avoid a recession this year. On the other side, there are some tricks to bring the housing market back to what we knew it to be. In our next video, we will share some of the things that could cause the market to rise. Watch Housing Market Explained: What Can Cause a Housing Market Rise 2022?